This is BD Daily Finance News Podcast, daily insights on markets, economy, and investing. Welcome to the Beyond Daily Finance Show for 2025, December 5th.
And I am your very confused guest, still trying to figure out if I should buy stocks, sell stocks, or just invest in canned beans.
Today, we have four big stories: the Fed and a fragile stock rally, Wall Street's AI lending binge, bold forecasts for 2026, and Netflix trying to buy basically all of Hollywood.
So it's vibes, robots, crystal balls, and binge watching. Honestly, that's my entire personality in one episode.
Let's start with the Fed and this year-end rally that might not be as safe as your 401k statement is pretending. Story 1 comes from Bank of America's Michael Hartnett. He's warning that the year-end stock rally is at risk if the Federal Reserve goes too dovish with rate cuts.
Wait, I thought markets love rate cuts. That's like telling Wall Street free drinks at the bar, no?
They do, up to a point. The concern is about why the Fed would cut. If they cut because inflation is under control and growth is fine, great. If they cut because the economy is rolling over, that's a different story.
So this is like your boss saying, you can leave early. Nice. Versus your boss saying, you can leave early because the company is on fire. Less nice.
Exactly. Hartnett's point is that if the Fed signals a very cautious outlook on the economy while cutting rates, it could kill risk appetite. Investors might think, what do they see that we don't?
Translate that into normal person money. If I am just trying to grow my retirement account, what does a too dovish Fed actually do to me?
Think of rates as the price of money. When they fall, borrowing gets cheaper, stocks usually go up, and bonds lose some yield. But if cuts come with recession fears, stock prices can fall, while safer bonds suddenly look more attractive.
So it's like your bank slashes your mortgage rate. Yay! But also, you just lost your job. Not yay. The context matters more than the number.
Right, and Hartnett is basically saying, don't get drunk on the idea of cuts. If the Fed sounds worried about growth, treat this rally as fragile, not guaranteed.
How fragile are we talking? Like, I should not look at my portfolio without a glass of wine? Or just maybe don't YOLO into meme stocks?
More the second one. Practically, this means having some diversification. If you are 100% in high-flying growth stocks that only work when everything is perfect, you are very exposed to a sentiment swing.
So maybe mix in some boring bonds, value stocks, cash, the financial equivalent of eating vegetables.
Exactly. And speaking of bonds, they are having a rough week. U.S. Treasuries are on track for their worst week in 6 months ahead of fresh inflation data.
Worst week in 6 months for bonds sounds like my week trying to do holiday shopping without checking my credit card statement.
Yields move opposite to prices. So a bad week for bonds means yields are jumping. That can pressure stocks, mortgages, and loan rates, even as people bet on future cuts.
So short-term, bonds are like, we are freaking out. Long-term, everyone still expects the Fed to calm things down with cuts. No wonder people are confused.
That confusion is exactly why you do not build a plan around one Fed meeting. You build it around your time horizon and your risk tolerance, then adjust gradually.
So action item here, check your mix. If your 2025 portfolio looks like a 22-year-old's meme stock account, maybe age it up a little.
Exactly. Let's move to story 2, where Wall Street is throwing money at AI and simultaneously trying not to blow itself up. Wall Street is gearing up to lend massive amounts of money to the biggest players in artificial intelligence, while also scrambling to cut its risk from what could become an AI borrowing binge.
So the banks are like, here, take our money, AI overlords, but also, please sign this 300-page prenup in case you turn out to be a bubble.
Pretty much. The AI build-out is insanely capital intensive. Think data centers, chips, power infrastructure. Those projects need billions in financing, and banks want that fee income.
For a bank, lending to AI right now is like what? Lending to people opening gold mines in a gold rush.
Exactly. Huge opportunity. But if everyone builds a gold mine and only a few strike real gold, some lenders get burned. So banks are syndicating loans, using covenants, and packaging risk into different tranches.
Ah, yes, the classic Wall Street move. If a risk looks scary, slice it into tiny pieces and sell it to everyone.
They are trying not to repeat the 2008 playbook. The difference here is that the collateral is physical infrastructure and big tech balance sheets, not subprime mortgages, but concentration risk is real.
So if you own bank stocks or bond funds, should you be worried that your money is quietly building the AI Death Star?
You should be aware, not panicked. Big banks are stress testing these portfolios and often spreading risk across investors. But if AI spending slows or profits disappoint, credit spreads could widen and bank earnings could get hit.
For regular people, is the lesson here, don't chase every AI stock just because your cousin says it's the new internet?
Yes, the infrastructure boom is real, but that does not mean every AI-related company is a good investment. Focus on balance sheets, cash flow, and whether they actually make money, not just cool demos.
So if the business model is, we lose money on every user, but make it up on volume, maybe pass.
Exactly. And this feeds straight into story 3, where people are asking whether this is an AI bubble or the start of a new market supercycle. Technical analysts are looking at leaders like Meta and Nvidia, asking whether the rally driven by the so-called Magnificent Seven is an AI bubble or the beginning of a long supercycle.
Every time I hear Magnificent Seven, I think cowboys, not mega cap tech. But sure, close enough.
A bubble is when prices run far ahead of fundamentals and then crash. A supercycle is when a structural shift, like the internet or smartphones, drives profits and valuations higher for years.
So bubble is sugar high, supercycle is finally eating enough protein and going to the gym.
Exactly. Technical analysis looks at price patterns, volume, support, and resistance levels. For stocks like Meta and Nvidia, charts show big run-ups, but also periods of consolidation, not just straight parabolic moves.
Meaning, what for someone who does not speak candlestick? Is this relax or grab the exit?
It means the market is cautious. There is still strong demand on pullbacks, which supports the supercycle argument, but valuations are stretched, which supports the bubble argument. Reality may be a messy middle.
Wall Street asks, is it A or B? And the answer is yes.
For a long-term investor, the key is position sizing. Owning some AI leaders through broad index funds or sector ETFs can make sense. Betting your entire future on one chip stock probably does not.
So instead of all in NVIDIA at the top, think, I will own the whole class, not just the kid who looks smartest right now.
Exactly, and that brings us to story 4, where Wall Street banks are looking past today's jitters and predicting double-digit stock gains in 2026. Several major Wall Street banks are forecasting double-digit gains for U.S. stocks in 2026, even as investors worry about tech spending and a potential AI bubble.
So current mood is, I am scared, but my 2026 self is apparently thriving.
These forecasts assume a few things. Inflation continues to cool, the Fed manages a soft landing, earnings grow, and AI plus reshoring and manufacturing investment support productivity.
So basically, everything has to go right. That feels optimistic, but okay.
It is optimistic, but long-term equity returns are often positive even through noise. For someone investing for retirement, the key is staying invested through cycles, not guessing the exact year.
So your 2026 forecast is less, S&P will be up 14.3%, and more, please just do not panic sell every time there is a scary headline.
Exactly. If you are dollar cost averaging into broad funds, these forecasts are a reminder that markets can climb walls of worry. Use dips to add, not to abandon your plan.
With the important caveat that blindly buying every dip is not magic, as a certain quant firm just reminded everyone.
Yes, research from AQR showed that simple buy-the-dip strategies are not as great as people think. Context and valuation matter, but systematic, regular investing still works over time.
So it is not buy every dip. It is have a plan. And sometimes the plan says chill.
Exactly. Now let's talk about the one stock story that is not even pretending to be chill. Netflix trying to buy Warner Bros. Discovery in an $83 billion deal. Netflix has agreed to buy Warner Bros. Discovery in a deal valued around $83 billion, which would transform it into the dominant Hollywood player.
So Netflix looked at the streaming war and said, what if we just buy the battlefield?
Pretty much. Warner brings HBO, DC, a huge film library, sports rights. Combined, that is an enormous content and distribution machine.
This is like if your favorite restaurant bought the grocery store, the farm, and the delivery app all at once.
Exactly. Netflix is vertically integrating content and distribution at massive scale. The bet is that synergies and pricing power will outweigh the huge debt and integration risk.
For normal people, does this mean my streaming bill goes up, my content library gets better, or both?
Likely both. Fewer big competitors usually means more pricing power, but you may also get more bundled content in one place, which some households will like.
And as an investor, this is not a guaranteed win, right? Big media mergers have a history of being messy.
Correct. Integration risk, regulatory risk, culture clashes, debt load, you name it. If you own Netflix, expect volatility and a long integration timeline.
So again, theme of the day, concentration cuts both ways. Great if it works, painful if it doesn't.
Exactly. If your portfolio is already heavy in big tech and media, this is another reason to check your exposure and not let one theme dominate your future.
All right, recap time before everyone goes to rebalance their 401k in a mild panic.
Today, we covered a fragile stock rally that depends on why the Fed cuts, Wall Street's cautious AI lending binge, the bubble versus supercycle debate around AI leaders, bullish 2026 forecasts, and Netflix's $83 billion Hollywood land grab.
Action steps for real humans. Do not bet your future on one AI stock. Use dips thoughtfully, and remember that giant mergers are risky, even when the press releases sound magical.
And remember, none of this is personal financial advice. It is a roadmap to ask better questions about your own situation and maybe avoid a few avoidable mistakes.
If you learned something today, hit subscribe, share this episode with a friend who keeps texting you about AI stocks, and leave a comment with your biggest money question this week.
You have been listening to BD Daily Finance News Podcast, daily insights on markets, economy, and investing. Thanks for hanging out with us on the Beyond Daily Finance Show.
We will be back next time with more markets, more jokes, and hopefully fewer reasons to panic check your portfolio at midnight.